Moving averages plot a line on the chart that represent the average price over a certain period of time. Now this is really helpful because all of the noise and the confusion of short-term price movements are completely removed, giving you a much clearer picture of what's really going on. And they can also provide insights into potential upcoming trends, support and resistance levels, and possible entry and exit points, particularly when different moving average lines are used together. More on that later. Moving averages work really well because so many traders use them. And when so many traders use the same indicator, it leads to herd mentality, which inevitably causes the price action to respect the moving average lines. The simple moving average is calculated by taking the price of an asset over a specified number of periods or days and dividing it by that number of days. It then plots out a line on the chart clearly showing the moving average. So if it's a 9-day SMA, the line would be calculated by adding up the closing price of each of the previous 9 days and then dividing that number by 9. Same goes for the 200-day SMA. The line would be calculated by adding up the closing price of the previous 200 days and then dividing that number by 200, giving you the average. People choose different length SMAs based on their trading objectives. Shorter moving averages like the 9-day are typically used for short-term trading, while longer-term moving averages like the 200-day are more suited for long-term investors. This is a 9-day SMA, and we can clearly see that it follows the shape of the price action and tends to act as support in uptrends and resistance in downtrends, and helps to smooth out price fluctuations. This is the 200-day SMA, and we can clearly see that when it's rising up but underneath the candles, it indicates an uptrend, and when it's falling but above the candles, it indicates that the market is in a downtrend. There are 4 main types of moving averages, but the 2 most common are the simple moving average, or SMA that we've just looked at, and the exponential moving average, or EMA. The exponential moving average is pretty much the same thing, except more consideration or weight is given to the more recent price changes, making it more responsive to stuff that's happening right now. And this is particularly helpful in volatile markets where the price changes quickly. And it's for this reason that the EMA is more commonly used amongst day traders. Be aware though, that because EMAs are more sensitive to short-term price spikes, they can end up producing more false signals. To show you the difference between the two, this is the 9-day SMA in white and the 9-day EMA in blue. The white SMA is much smoother and looser, whereas the blue EMA is more jagged and tighter to the price action. So let's have a look at a few examples of how we can use these to help us time an entry. I'm using TD365 as my broker, but all platforms should have moving averages available to you. And if you'd like to use TD365 for yourself, then there's a link in the description box below, which you can use to sign up with. So in this example, we can see that the price has broken above the moving average line here, indicating that the price could rally, and we might consider taking a long position at this point. And in this example, we can see that the price has broken below the moving average line here, indicating that the price could fall, and we might consider taking a short position at this point. Moving averages can also be used as dynamic support and resistance levels, as opposed to static support and resistance levels that we draw in manually. For this, we'll need a longer period moving average than the 9-day in order to give us a stronger, more accurate reading of support and resistance. So we'll use the 100-day simple moving average. So let's add that to the chart. Here we see that in the pre-market, the price has used the 100-day SMA as support in this area. There was a slight pullback, which is to be expected at this time of the day, and then it burst back through. We see that the support level held in these 3 points here, and once it broke through the support at this point, the price dropped significantly. So for a broad outline of dynamic support and resistance, the 100-day SMA can be quite helpful. To be honest though, you can get a lot of false signals using moving averages on their own in this way, as they're what's called lagging indicators, meaning that they take their data from stuff that's in the past. So a better way to use them is to use 3 different moving averages all together at the same time. And by doing this, we give ourselves a much stronger, clearer and earlier confirmation on new trends and their potential strength, as well as a clearer assessment of the current risk. For this strategy, I'm going to use what's called a 5, 8, 13 moving average. And these numbers are derived from something called the Fibonacci sequence, which is a video for another day. But for now, all we need to know are a few simple steps of how to set this up. For the 5, 8, 13 strategy, we're going to use SMAs because we want as few false signals as possible. You can do this in whatever broker or charting platform you're using, but in TD365, again, I'll head to Studies, type in Moving Average, select that, and I'm going to type 5 into the period box and make sure that Simple is selected. Let's change the color to white. And there we can see we have the 5-day simple moving average on the chart. Now let's do the same quickly for the 8-day and the 13-day. And I'm going to change the colors to blue for the 8-day and pink for the 13-day. First thing to look at is the spacing between the moving average lines. And this can quickly tell us a number of things. When the spacing between the 3 lines is nice and wide and sloping upwards, it's a strong indication of an uptrend. You'll notice the price action tends to be above all 3 SMA lines. And this could be a good time to buy, and an especially good place to time an entry would be if the price pulls back to the blue 8 or pink 13 line. Conversely, when the spacing between the 3 lines is nice and wide but sloping downwards, it is a strong indication of, you guessed it, a downtrend. You'll notice the price action tends to be below all the 3 SMA lines, and this could be a good time to sell. When there is wide but erratic spaces between the lines, this is a sign that the market is in a state of volatility. You'll see big moves in price action pulling away from the SMAs, but with sharp reversals. Also, when the lines become tight together and frequently cross over each other, then this is a sign of a choppy or flat market, and this is best to be avoided. Just sit it out and wait for a sign of an emerging trend. And to do that, we look for when the 5-day SMA, in this case the white line, crosses over the blue 8 and the pink 13 SMA lines. This is a sign that a new trend could be starting, so keep your eye on it and look at the price action. Are the candles above all 3 lines, indicating an uptrend? If yes, then this could potentially be a great place for an entry. So to scope out a new trend, we look for where the shorter term moving average line crosses over a longer term moving average line. So in this case, when the 5-day SMA crosses over the 18 and the 13-day SMA. This indicates a potential trend reversal and could signal a buying or selling opportunity. So in an uptrend, we would look at the price action and make sure that the candles are consistently above the 3 SMA lines. And when the price pulls back to the 8 or 13-day SMA line, that indicates a good entry point, and we can put our stop loss just under the 13-day pink SMA line. Now, in order not to get stopped out, check the previous levels of support and draw in your lines in order to make a more informed decision as to exactly where to place the stop. Let's have another look at a bullish crossover. We can see in this example the white 5-day SMA line has crossed above the 8 and 13-day SMAs, meaning that there's an uptrend in the market. Candles are consistently above the 3 SMA lines, and when the price pulls back to the blue 8-day SMA line, that is a good entry point with our stop loss just under the 13-day pink SMA line. We can also see that the price started to come back down again after the white 5-day SMA crossed below the 8 and 13-day SMAs. So that was our indication to exit the trade if we were still in it, or it could be a good opportunity to go for a short position. So when the price pulls back up to the 8-day SMA, that is a good entry point with our stop loss just above the white 5-day SMA line. Now you can use this 5, 8, 13 SMA crossover strategy with exponential moving averages too, in exactly the same way. I just need to make sure that I select exponential in this box here, and I'll add all 3 of those onto the chart. So now I've changed the 3 SMAs that we had before to EMAs, and we can use the same crossover strategy in the same way. Except this time, the lines will be more reactive to the current price, meaning that they will be tighter together and, depending on your experience, easier to interpret. And just to show you the comparison between the 3 SMA and the 3 EMA lines, I can flip between the two just to show you how much more responsive the EMA is than the SMA. The EMA lines are much closer together and not as smoothed out as the SMA lines, meaning that the EMA could be interpreted with more clarity, but this comes down to your trading style, experience and personal choice. So I would recommend trying both out in demo mode and seeing what works for you. Or maybe a combination of the two could work out, as it does for many people. So let's see how these lines play out live as we go to the Dow. 25 minutes after the market opened, the 583 EMA is in action here, and you can see that we've had a crossover at this point, where the white 5-day EMA has crossed over both the 8 and 13 EMA lines, and that would have made for a good entry down there. Now we can see that the price is starting to fall, but I'm going to wait for confirmation and see if the white 5-day EMA line crosses underneath the other two lines. And there it crosses over. Our second confirmation would be to see if the price comes back up to retest that level, and if it does, it could be a good entry for a short position. It's finding a bit of support in this area, but let's just wait and see if it holds it. It's come back up to retest the crossover level, and it could go either way here, so I'll hold off for a minute. If I see a big move, I'm going to place my entry. And that's where I would go short. And as you can see, that would have been a very quick and successful scalp right there, as I would have had a take profit order in this area here, as it's a key level of support. Now let's have a look at this same scenario, but with the SMA instead. And we can see that after the white 5-day SMA crossed over here, the price retested perfectly up to the pink 13-day SMA, which was our desired entry point. So this particular example with the SMA was actually much clearer and easier to interpret than it was with the EMA. So it comes down to experimentation to see what works for you and lots of practice. Now if you want to take this concept even further, there is a much more powerful indicator which is based on these moving average crossovers, and it's called the MACD indicator. It's pretty straightforward and it's easy to understand if you've already grasped the crossover concept. And you can watch my video on it by clicking this up here. Remember, it's essential to combine these indicators with price action and your own support and resistance levels and risk management in order to increase the reliability of your decisions. And remember, indicators are there to guide, not to inform. Moving averages are extremely useful in day trading, but they're not without their flaws. First off, they can be a bit slow to catch up to market changes, so they might not give you the timely signals that you might need. Plus, they can sometimes give you false signals in choppy or flatlining markets. They tend to work best in trending markets, so remember to only try this out in demo mode to really get to grips with what you're actually looking at. Now, best of luck, thanks for watching, and I'll see you next time right here on Math Market.